Okay, good morning everyone. This is going to be the brief for the 1st of December 2017, first day of the last month of the year. And what an incredible year it has been. We're going to be talking a little bit about sort of the price action we saw yesterday, which was a bit unique. It wouldn't fit any of your traditional criteria. We'll be discussing that shortly. Following on, then we're going to discuss what happened to the equity market, why it has continued to ramp higher. I know we talk about it every single day. The equity market is moving higher, but hopefully taking another little spin on it and putting some figures and numbers
just warming it now on that Italian
to the move. Then we're going to quickly discuss the OPEC meeting, which was largely a non-event, but just having a look at where oil is priced, the US output production, what the future holds for the oil market, and then finally look at the day ahead, and then we'll wrap up relatively quickly given the fact that we had a technical issue starting the brief, so we are starting about 20 minutes late. Okay, so first up on the calendar, we're going to have a flick through yesterday's price action. And let me just get the charts. So yesterday was largely uneventful, particularly in the morning. There was nothing much going on, and I felt like that's been the theme for the majority of this week. The majority of this week, the money to be made or the trades to be taken were really just waiting and seeing, really waiting for the market to give you a direction, to give you a wink, and then acting. Trying to be too preemptive this time round hasn't really worked this week, at least from what I've been observing. So having a look yesterday, I think the main data that we saw was the European inflation numbers, which were a 0.1 miss month on month and year on year. This ultimately drove down the euro. We came to a beautiful technical price point of S1, which also sort of defined the bottom of the range. I know some of the traders here capitalized on the short and also went long as well. One of the hybrid guys was discussing this with him, and I think his analysis of this was excellent. I myself got long the S1 as well as him. A 0.1 miss on the month and the year on year doesn't really change anything in terms of monetary policy, therefore shouldn't really have a lasting effect on the euro. This is status quo at the moment, lower inflation, so nothing drastic, 0.1% misses. But what this did do was help us move all the way lower to the bottom of the range, which presented a really good buying opportunity. Looking at the bigger picture, what the market's more concerned with is the European growth scenario. So this was a great buying opportunity. It got to the top of the range, which was also largely defined by this R1 level. After we broke through there, we saw a bit of violent price action as we drove all the way to R2 and then sort of chopped around there for a while. But you can see there was a bit of resistance here initially, but once we got through there, really a straight line up towards the R2 level. Nothing was driving this higher. If we have a look at what's been happening with the euro most recently, it has been in an uptrend, so sentiment is relatively positive, but a break of this here led to some broad-based dollar weakness, but not dollar weakness in your traditional sense. It was dollar weakness mainly focused on the FX pairs, because we didn't see that dollar weakness reciprocated in either gold or T-notes, which was kind of unique. You don't see that very often. But just talking about the relationship between the euro dollar and the equity market, we're going to be touching upon that just after I finish the review of yesterday's price action, because I think it goes a long way to explain why we've seen, or helps to explain why we've seen such a push higher in the equity market. So that's having a look at the euro. As this was pushing higher, and as I said, this was really FX-based dollar weakness as opposed to driving gold up any higher. As you can see here, gold actually had a negative day coming under pressure, which would be more indicative in normal sort of correlations of dollar strength. But cable as well on the front foot, trading above R2. This also follows on from the slight upbeat that the market is quite confident about Brexit talks going through for the EU summit. So we saw euro dollar higher, cable higher. Having a quick look at the dollar yen. The dollar yen heading on to 60-minute here. Initial dollar weakness, then dollar strength coming into the end, which is also an interesting move because we didn't see the euro manage to retrace all of its dollar weakness here. However, dollar yen retraced it and then went up some as equity markets kept on pushing higher. So the reason I'm spending a little bit more time on this today is because if we had a look at what happened to the DAX drove higher initially in the morning on the back of that euro weakness. Just the lower inflation numbers, meaning maybe an edge towards slightly more positive or more supportive conditions coming out of the ECB. Took us to the top of the range, and then ultimately we found resistance there, and DAX came under some sustained pressure for the rest of the session, whilst on the other side of the pond we saw the S&P have a massive rally. We draw up a currency tool here from the lows to the highs of the day, 1.38%, which is a fantastic day to the upside. Had we seen a 1.38% move to the downside, that would have been headline news. But now with the equity market pushing higher and higher and higher, it's becoming a little bit uninspiring. But still a very positive session for the S&P, a very positive session for the Dow as well, moving sharply higher. This is on the back of well, a number of things, but this recent leg high has been pushed due to Powell being supportive of financial deregulation, which would be supportive of the financial sector. So an outperformance in the Dow, S&P following suit. Nasdaq still playing catch up here, having recovered about half of its move. If I draw a fib here, this may be interesting. Highs, the lows. Yeah, so that's 61.8%. 61% providing some good resistance technically to the upside, down to test pivot, which is also the 38.2% here, so likely to see some support here. So Nasdaq still has a catch-up gain. We're seeing sector rotation. FANG stocks have been outperforming month on month on month, so coming into the end of the year, seeing some people maybe book some profit there, move there, or book their profit and then sort of reallocate their capital elsewhere. And then, so that recaps yesterday's price action. Having a look at oil, quite a subdued day, given the fact that, especially for some of the new guys, they would seem to think that, given the OPEC meeting and then the sort of conversation that they were about extending their cuts till the end of 2018, we should see more violent price action. Not necessarily the case. That's been fully priced in. I think anything short of a deepening of the cuts is now going to fall short of anything impressive enough to move the market. So what we have been seeing as well has been coming under pressure now for about a week, a whole trading week now. So buy the rumor, sell the fact. We just started selling the fact a little bit earlier based on the last time we had the OPEC meeting and they announced their cuts and extensions in the first place. So we're going to touch upon oil a little bit, but just going back to this equity market, I wanted to talk about why this is happening. So we know the US economy is doing well. We know that Powell is supporting deregulation, which is all good and fine for the equity market. But one thing that I do want to note here is the fact that, so we know the soft data is doing well, hard data is doing well, but if I just transition my chart over, and let's just have a look at what the dollar's been doing. So the Fed has hiked twice. They're going to hike a third time in December. That's now fully priced in. So if we look at the December expectations, which is not loading up, here we go. So 90.2% of the market expect an interest rate hike in December, which is fully priced in and comfortable. Jan is not going to be the FOMC sort of press conference afterwards, so it's every 12 weeks we're concerned with. So then looking at March 2018, 55.1% of the market is priced in a hike. So this is now 4 months out. Then we're going to look at June. Go to mid-June, 32.7% already priced in for the second hike of 2018. So we've priced in the next two hikes, and the third one is not far away from being priced in. So we should be seeing some broad-based dollar strength here. But if we go to the dollar index, which I have now managed to close, let me split this up again. Dollar index investing. The dollar hasn't been strengthening. We go to the daily chart, put it to candles, and zoom out. So daily candles here. So you can see beginning of 2008 to 2017, as soon as the year started, we started selling the dollar as the back of the Trumpflation trade, leaving the yield market and the FX, the bond market and the FX market. We saw a little bounce here when we had that Trumpflation trade sort of re-inspire, but ultimately the dollar is trading down at its lows for the year. which is quite surprising given the fact that we've hiked twice, going for a third one, priced in the one after that, and not far off pricing in 3 hikes down the line. So one way to go about explaining this is looking at the dollar index composition, which is over here. So you're using your very reliable Wikipedia as a source. US dollar index, 57.6% is weighted against the euro. And as we know, we've seen huge confidence in the euro area. If we put this now onto a weekly chart, since 2017, we've seen the euro dollar rally. As it's been rallying, we then saw that Trumpflation trade here as well. So this is basically the inverse of the dollar index chart that we've seen. This is the dollar weakness, this little bounce we're talking about, and this is some further dollar weakness. So this dollar weakness is largely driven by incredible optimism and strength in the euro area. And this, again, is the Eurozone being a very large trading region in the world. The euro is strong against the dollar. This is obviously being very supportive of equity markets. So just to shed some light, I'm sure a lot of people do scratch their head from time to time, including myself, as to why equity markets continue to rally. But then, if the dollar is so cheap, whilst the Fed is hiking into a very strong economy, it's almost like, well, it is the Goldilocks scenario: strong economic data, cheap currency, supporting your equity market as a whole. Okay, next I wanted to quickly discuss. We spoke a little bit about the commodities market. The commodities market, we've seen oil sort of tick higher. In terms of our data calendar for the rest of the session, guys, sorry, I'm aware we're coming up to 9 o'clock, but the session did start a bit later. Data calendar, nothing too inspiring here. We saw the Kaizen manufacturing data come out this morning. If we just got into trading economics, we can have a look at sort of where we are printing on that reading. Thursday, Friday. Manufacturing. So we got in 50.8 versus 50.9, so a slight miss there. Next in the data calendar as the session progresses. Nothing particularly notable. So 9 o'clock we have the manufacturing PMI final readings from the euro area. So final readings will be slightly less inspiring here coming into the rest of the session. So we have Canadian GDP growth rate quarter on quarter coming out month on month, unemployment rate full time. So any of the CAD traders, this is a really important day. We've got a lot of tier 1 data coming out here. Anybody who does trade the CAD, you guys should be aware that when it comes to tier 1 data, the move is basically over in about 90 seconds. It's very difficult to sometimes see the CAD. You'll have an amazing number and it sort of finishes its move within 1 minute. If you're getting too involved up at the top, you'll see that the price action becomes quite lackluster up there. Coming into the afternoon then, we have Fed's Bullard speaking, Fed's Kaplan speaking, the market manufacturing PMI 245, then we have the 3 p.m. ISM manufacturing. Most important part here would be your headline manufacturing PMI month in November. And yeah, otherwise we got the Baker Hughes rig count again on at the end of the day, which will give us a good indication. There was a couple of charts I wanted to speak about with regards to the oil prices. So 6 p.m. US Baker Hughes rig count. Just wanted to have a look at output production from the United States, and we can see here, you know, with oil trading where it is, we've seen this is hugely profitable for shale oil producers, and shale oil producers are going to be quite happy with oil trading around $60 now that their average price has come down between $30 to $35. So we are seeing a huge amount of production come out of the United States. And having a look at this chart here, you can see that we're right up at the top of our range here. The only time we were higher was in 1970s, where we were only fractionally higher, about 9.6 million barrels, 9.5 million barrels per day at the moment, but sort of the United States production peak is at 9.6 million barrels. So I'm not particularly convinced, as I've been saying now for a few weeks, that oil prices can really sustain themselves above the $60 mark at some point. You know, one of the most capitalistic countries in the world is going to capitalize on this higher oil prices now that they can export oil to the rest of the world. If oil continues to go up, we're only going to see US output production continue to ramp higher. Supply should start then outstripping demand, but I think one reason I was being a little bit stubborn initially with my oil call of it going lower is definitely looking more at the supply side. Now, the demand side is healthy and it is going to be picking up, but I'm not convinced that's going to allow us to sustain ourselves anywhere above the $60 mark, given the fact that US production is coming up to all-time highs and is going to surpass the 10 million barrels per day mark. Okay, so that is wrapping up your brief for today. So again, a lot of US economic data coming out in the afternoon around 12 to 2:30. Any CAD traders, definitely be staying out of the market so you can make the most of the opportunity of the Canadian data coming out. Otherwise, coming into the afternoon, I reckon, as usual, on Fridays around 3 p.m., 3:30 to 4 o'clock, we'll start to see volume start to die out. So it's better to book your profits or accept your losses a little bit earlier on Fridays and then call the end of the session. Just having a flick, I didn't discuss the current price action, what we've seen so far. So with the euro trading where it is quite high, following on from that dollar weakness we saw yesterday, we have seen gold have a technical break lower on the session. Had a trend line falling down, break of the lows. We've seen some sort of double bottoms being taken out. And you can see it really just taking us down to the bottom of the range. Nothing driving this market at the moment. Just a very aggressive break lower of the low. You can see this candle here started here, drove all the way down. This is that selling pressure taking out the 13,000, taking out S1. And we're just seeing an extension now. We're sort of flirting with this S2 level. I wouldn't really wanting to get too involved down here unless we start to see euro break higher. Looking across the board, however, we are seeing the Aussie dollar trend higher as well. So dollar weakness in play at the moment, driving euro higher, driving European equity markets down. I was told to definitely mention Bitcoin before finishing off the briefing. I have definitely started looking more at Bitcoin just simply because it needed to be done. And it's not been too bad. I mean, the first week I looked at it, we went from 8,000 to 11,000 in basically a drop of a hat. But we've started to stabilize now, having bounced off 11,000. We've traded around the 9,000, 10,000, 9,500 marks. We're seeing a bit of either consolidation, well, most definitely consolidation, but this aggressive day in, day out buying has, at least for now, subsided. We're seeing a bit of calm in this market. It'll be interesting to see if we can make a break higher again, or if this is coming into futures being released on the CME. If this is where the market sort of takes a step back, waits for the big boy money to come into the market and drive the asset class higher or lower. Discussion is whether when the Bitcoin futures open, is it going to go higher or lower? We got varying calls in the office. Some people think it's going to go straight down. Some people think it's going to rally. In my opinion, I think we're going to see a very aggressive move higher before we start selling off. So maybe people are just waiting for the futures to be released, which I think is a bit of a push. I don't think much of the retail market truly understands what the futures market is and how that is used by institutions and what it's used for. So it'll be interesting to watch out for. Only a couple of weeks now till CME release the futures product. Okay, guys, thank you very much. That's 9 o'clock. If you have any questions, please let me know. I'll be in the trading live room as the day goes on. Thank you very much. Have a good day.